The event will begin shortly. We are waiting for all our guests to join the event. Thank you for your patience. Hello, everyone. My name is Nosheen, and I welcome you all to today's panel discussion, where our esteemed panelists will delve into the intricate world of venture capital, exploring the strategies that tech startups can employ to secure crucial funding for their growth and development. Today, we have a fantastic panel discussion on the topic Decoding Venture Capital Strategies for Tech Startup Funding. It's my pleasure to introduce KiwiTech, a one-of-a-kind innovation ecosystem that's home to 500 plus portfolio startups and 300 plus mentors, all committing to supporting innovators globally. It all began in 2009 when a team of seasoned entrepreneurs who had previously built and scaled a publishing services company for a 9-digit exit decided to start another company to empower startups with innovation. All in all, we at KiwiTech particularly team up with early to late stage startups to support entrepreneurs with 360-degree support in terms of technology, fundraising, mentorship, networking opportunities, and go-to-market strategy. Before we start with the panel discussion, we have recently introduced a referral program at KiwiTech. This program rewards anyone who contributes to fruitful introductions to our company. So if you know someone looking for tech development support to scale, join our referral program and follow the steps shown on your screen, or visit our website mentioned in the chat to learn more, contribute to our growth journey, and earn incentives for your trust in us. Now, without further ado, I would like to invite our panel moderator, Ayuk Sayed, SVP of Strategic Partnerships at KiwiTech, to start with the panel discussion. The screen is all yours, Ayuk.
Hi, Nosheen, can you see me and hear me?
Yes.
Wonderful. Well, good afternoon. Good morning, folks, depending on which part of the world you're dialing in from. As Nosheen mentioned, my name is Ike. I'm the SVP of Strategic Partnerships at KiwiTech, based in the Washington, D.C. area. It's a real pleasure to welcome all of you dialing in again from different parts of the country, different parts of the world. A panel discussion on decoding venture capital strategies for tech startup funding. Super excited to have our three esteemed panelists join us. I will call them out one by last name, one by one, would request them to turn their video on and turn their audio on. First, joining us from Toronto is Brian Duarte, my fellow Canuck. Second, we have Sarah, my fellow DMV resident, joining us. And third, from Houston, my fellow MIT classmate, Emil. So again, really excited to have all three of you. What I'd like all three of you to do in that order is to just share a little bit of background on yourself, on your firm, maybe the firm you're about to join or launch, kind of what your investment thesis is. Would just love to have our audience a little bit of background info on who you are. So Brian, we'll start with you.
Sure. Thanks very much, Ike, and thanks for having me here today. So yeah, I'm Brian Duarte, as I said, managing partner for Black Tech Capital. Black Tech Capital, we're tackling, where we say social justice meets climate responsibility. So we're investing in Black and other underrepresented founders in the climate tech, clean tech space. My background has been over 30 plus years in the energy sector, first in the corporate world, working in the utilities, natural gas, electricity sector, and then started off after that as an entrepreneur, created a number of different companies, had 2 exits from those companies. And then back in 2021, really when I'd been mentoring different startups for a number of years at that point, really wanted to make a difference and focus on founders like myself and other founders that I weren't seeing getting funded. Today we're still seeing in the venture world, women founders getting less than 2% of the funding or thereabouts, Black founders around 1%. So wanted to make a difference in that area and also to bring in my expertise on the clean tech climate side. So that's a little bit about me.
Yeah, I want to echo that, Ike. Thank you so much for having us. So I am an associate member of SWAN. We're an angel impact network. And we are comprised of about 85 angel investors across a number of different sectors, but our primary focus is about 65% to climate tech, another 30% or so to healthcare, and then another 5% or so, hoping that math works out, another 5% or so to sort of education and other wellness. And so, yeah, I mean, what impact looks like for us does vary by sector, but we are equally sort of committed to strong financial returns and generating positive impact. I also am pursuing a fellowship at the Venture Institute for Ethical Investors, and I will be joining OCA Ventures on their healthcare team in January. Prior to spending time in venture, I spent 5 years directing a healthcare nonprofit. That's sort of where my healthcare background comes in, and a year in private equity, where some of my more technical investing expertise comes in.
Wonderful. Good for the OCA folks. Emil, you're next.
Yeah, great to see you all. Thank you for the invite. I'm a principal at Applied Crypto Ventures. We're focused on blockchain infrastructure and applications. And I've been in venture capital for about a decade. Have been investing in blockchain for about 5-6 years. Prior to that, I spent a couple of years at Liberty Mutual within their corporate venturing group, and earlier worked in the clean tech as part of the Massachusetts Clean Energy Fund. I started my career in venture capital at General Catalyst Partners. And before venture capital, I spent 5 years in the energy field and 2 years at IBM launching a software product.
Fantastic. So folks, as you can see, our panelists are coming from varied backgrounds, healthcare, Web3, looking at the market up in Canada with a mix of a social impact angle as well as giving back to the community. So again, should be a lively discussion. Let's dive right into it. For our audience, feel free to submit your questions on the Q&A window, on the chat window. I believe we're also live streaming this. So again, feel free to post your questions, and then I'll have the team pass it on to me and I'll put it to our panelists. If you want to address a specific panelists directly, you can mention their name too, and again, ask them any questions. So I'll post a link in the chat window. This is from Crunchbase, a report that came out. Just 1 second. I'll turn the chat window on and I'll share it for everybody's benefit. Global venture funding in the third quarter of 2023 reached $73 billion. Now, just surprising given where the interest rates are, and given that they have no indication of falling, it was actually up on a quarter-over-quarter basis. So a little bit up from where it was in second quarter of 2023, but still 15% down from the $86 billion that have been invested in Q3 of 2022. So basically, same quarter last year. Basically, this shows that, and I'll put the link in the chat window for those of you who want to see it. So basically, it's showing that while Q1 and Q2, may be the worst that is behind us, hopefully this is now we are turning a corner into Q3 and hopefully now in middle of Q4. I want to start with the three of you, and again, we'll start in the same order, starting with Brian, going to Sarah, and then Emil. What are some of the key strategies that tech startups should now employ when they're looking at venture capital funding, kind of given this backdrop in mind? We have turned a corner, maybe not showing how Q4 might bear out. How should startups think about this when they're talking to VCs, the GPs, kind of keeping obviously their LPs in the back of their mind. So Brian, I want to start with you.
Sure. So yeah, I think when tech companies are looking at funding in general, I mean, you want to start off by looking at what's your window. What are you looking, where do you need to raise by, and have a strategy in place. I mean, most startups fail from lack of funding, right? So if you don't have a strategy in place and you're just coming to the market when you need to raise money, it's probably too late. So you need to have a strategy in place to say, okay, if I'm starting off early, when do I need my seed funding? When am I looking at a Series A and a Series B? And at each stage, when you're looking at potential investors, you're looking to see who can help bring you to that next stage as well, not just looking at the dollar. So that's part of the strategy, because when you're approaching a venture fund, right now, as you said, you look at the statistics, more money seems to be being deployed right now. It's starting to pick up. It varies by industry. The industry I'm in, the clean tech, climate tech industry, that saw not as far as a drop as others. Valuations did come down, but we didn't see as a big drop. Whereas you look at some other industries, the drops were bigger. You look at things like AI right now, that's a hot item. So a lot of money is going towards it. So it depends on, so you also have to look at which industry and which vertical you're in when you're going out. So that's it. And have a strategy. To me, it's not a strategy of just going out and asking any investor. One, you want to develop a relationship with the investor up front. You want to make sure that they are deploying in your particular area, and you want to make sure they're deploying capital when you want it, right? If you approach a venture fund and they're saying, yeah, we've deployed our capital already for the year and we're not deploying for another 6 to 9 months, and you're looking for something sooner, that doesn't make sense. But building that relationship is a key part of the strategy right now when you're looking to venture funding.
Great. Sarah?
Yeah, so I agree with everything Brian said. I would also just encourage sort of framing of, because I think founders are really comfortable with the idea of selling a product. And when you're raising funding, you're actually selling your company's equity. So all the things that you do when you're launching a product for your startup, you're also going to do when you're fundraising. So I really recommend that founders first start with deep market research. They understand what the trends are in venture capital. We might be turning a corner, but the reality is the past year, check sizes have been down, deal volume has been down. Make sure your ask fits with the current market trends. Once you know what your ask is, you can start really diving into, as Brian said, which firms are sort of going to be able to meet that ask. So you want to see what check size they typically write. You want to see what sector they play in. You want to see what stages they typically fund, and make sure that you're targeting the right venture capital firms. Once you have your target list, you also really want to dial in what are the benchmarks, and Brian talked about this, but what are the benchmarks that they typically look for, and make sure that you've hit all or at least most of those benchmarks before you get out in front of venture capitalists.
Well, on my end, and I totally agree with the previous speakers, being in blockchain, so speaking of valuations, they're actually down not by 50, but in some occasions 75%. So it's been a total, winter in the market. And as far as raising capital, again, agree with the previous speakers. What I see in some entrepreneurs is an unclear value proposition. Even though in a down market, VC will invest in a high quality company, which as Sarah touched on, the product, the market, all of those have to work together to make it an attractive proposition. And VCs, again, will invest in a high quality company. So nailing down your value proposition and differentiation, your product, and your go-to-market strategy, and having a pipeline of either design partners or customers will make it an attractive company. As far as sort of the tactics of doing VC funding, again, great. You need to do research up front and develop relationships up front. I would suggest also getting introductions. So the best introduction to a VC So cold outreach definitely, obviously, is not the best idea. As far as introductions are concerned, the best introductions that I've seen are from entrepreneurs, successful entrepreneurs, previously backed by VC that you're trying to reach. So that's could be the best. The next best would be a venture capital, introductions through another venture capital fund who is interested in investing, and perhaps already in due diligence process. We do share deals, and therefore it could be a great way to get in the door. As far as venture capital introductions are concerned, this could be a double-edged sword, because sometimes VC will introduce a company, and the first question another VC asks, are you investing? So be cognizant of that, and make sure that you have good relationship and they're interested before asking for those. As far as other sort of funding sources, I remember when 2009, 2010 market downturn happened, other sort of sources of capital sort of filled the void. Obviously, those are angel investors, as well as in some states, for sure, Massachusetts, Connecticut, New York, they have state-run funds or quasi-funds. One of the funds that I worked at myself was Massachusetts Clean Energy Fund, where we have invested in energy companies because, during that time, venture capital did not look favorably upon the clean tech companies. So look for other sources of capital as well, and make your company an attractive investment opportunity. So that would be my sort of advice.
Yeah, and I want to echo something off of what Emil just shared there. Yes, certain sectors like the clean tech, climate tech sector, there are other sources like grant funding. So usually there's a good strategy. You raise some equity capital, say from a venture fund, and that sort of de-risks it for going in and getting now the grant money that now is undiluted capital, which us venture capitalists love. But it's a way to take your company to another level without having to dilute it even further. So other sources of funding is definitely something to go look after.
Yeah, like SBIR, Department of Energy, Department of Defense, and I'm sure there's Department of Health. All of those have, I know for sure SBIR phase 1, phase 2. So those are great programs.
Absolutely. And again, a good link that I came across earlier today, just speaking about the kind of nuclear winter and the valuations that Emil was referring to. I'll put this in the chat window, where startups that were raising a Series C in third quarter of 2023, the one that just finished, waited an average of almost 3 years since their Series B was done, almost 1,100 days. And for those that raised a Series A, the time from the seed round was 787 days, so a little bit more than 2 years. So again, what the data is showing that the later you are in your raise, essentially the longer time period it's taking, and it's growing over time. Again, especially with kind of where the economy is right now. So maybe good news for a lot of our audience who are very, very early stage, that you're not going to have to wait 2 or 3 years. Hopefully a lot of them, especially the company that KiwiTech works with, are pre-seed or at that seed stage. So things are generally looking a little bit better, but again, overall, just quite a bit of just being realistic in terms of valuation, that when you're talking to investors and kind of where you should be at. Good. Going to our second question, and I'm going to go in reverse order now. So Emil, maybe stick with you, then Sarah, then Brian. Is how do you assess the potential of a startup before you invest in them? And that maybe combined with Peter's question that just kind of came into the chat window in terms of how do you find startups? Maybe we'll kind of answer both questions at the same time. How do you find startups in which to invest in? And of the ones that you do look at, kind of how do you assess their potential? Emil?
Okay, how do I find startups? There are several sort of channels that I look at. Obviously, one is the outreach. When I go out and meet startups at the conferences, sort of the outbound channel. Of course, I get a lot of inbound through various sources, email, LinkedIn. Other sources, I would say, that been very sort of successful entrepreneurs who refer other founders. Those tend to be higher quality, as well as other venture capitalists who are also investing, looking for their sort of partner to participate in the round. So that's yet another sort of source. And of course, there are other ways to look for that I don't really deploy that much. I mean, there's PitchBook, there's Crunchbase. Since most of my investment's been in seed stage, usually those sources are already sort of not as useful, because if they're already in PitchBook, they already have received their seed round. So I have to be a little bit more creative in how do I look for companies. But for others who invest in later stages, PitchBook and Crunchbase could also be a good source. Was there another question? How we make a decision, or?
And how do you assess the potential?
Oh yeah,
metrics?
well, again, I come from just to be clear, I come from the business to business sort of B2B background. So my explanation would be sort of in that kind of through that kind of lens. So obviously, and it's an age-old question: what do you prefer, a team or a market? To me, it's both. The ideal team would be where you have a highly technical founder with a business savvy co-founder, ideally who have had exits in the past. And I believe there's actually MIT Sloan research that was published years ago, basically that mentioned that a 20% better chance for a company to be a successful company if entrepreneurs have exited successfully in the past. So that's sort of the ideal sort of picture. Obviously, market size, and that does not always correlate with the problem size. So, and when I hear an entrepreneur mentioning market size, I always ask sort of for bottom-up analysis. So that plays a key role there as well. And of course, technological and product differentiation. If we're talking about some incremental improvement, it's not necessarily a venture fundable company, because by the time you go to market, especially if it's in clean tech and material science, if it's incremental improvement, by the time you get to market, your technology will offer pretty much similar product on par with the rest of the market. So it will have to be disruptive. And of course, customer pipeline or design partner pipeline. I always look for that. And basically the key question that I'm trying to answer is, why would a customer buy from you and not someone else? So competition plays a key role. And is there enough customers? Are there enough customers that will allow you to build a big enough company? Of course, economics would also play a role. It's less of an issue with software companies, but generally we're looking for at least 50 to 60% margin. Of course, it's different for clean energy, and I will allow other panelists to answer this question, but that's my 2 cents.
Yeah, I would probably echo everything that Emil said. I would just add for myself in terms of sourcing, in addition to the activities that Emil highlighted, I definitely leverage my alma mater. So I went to Berkeley Law. Berkeley is one of the leading sort of startup ecosystems. So getting really plugged into the networks that you're already a part of, and finding sort of founders early in their journey and sort of developing that relationship, even if they're not quite ready to raise capital, is a really rewarding way to get in there early. In terms of how to assess a startup, one thing I would flag, because we all are sort of representing the earlier stages, is that assessment is going to differ depending on what stage you're at. And that intuitively makes sense, right? Like if you're a revenue generating company, we have DCF models, the venture capital method, we have all of these methods for assessing revenue generating companies. When you're pre-revenue, and that's the stages that most of us represent here, we kind of have to rely on different factors. And Emil highlighted those beautifully. I think at the really early stages, I personally tend to focus on team and TAM the most, but I would agree with Emil that early indicators of traction, go-to-market strategy, competitive landscape also factor in.
So adding on to what Sarah and Emil said, all those factors play, and I think something a little bit different that we do. So I'll answer the question first about finding startups. I tend to go looking for the companies more than what come out, and I tend to like companies that have gone through at least some sort of an accelerator. So they've proven themselves. They're showing, again, because we're looking at the early stage. And because we're looking at overlooked and underrepresented founders, they don't necessarily have had previous experience or previous startups. It's great if they have, obviously, and doesn't matter to me if that has failed or succeeded. But looking to see, what the founder's background is like. And when we find good companies, and whether they come from referral or we've gone looking for them because our involvement of our team in a number of different accelerators, I spend time with that founder. So we like to mentor them, go through at least a period of a couple of months before we're even considering assessing whether. I'm not going to go chasing the latest hot thing. I'm looking to see, are they capable? Is this the right team? Do they have the right thing together? And as both Emil and Sarah said, is the market big enough for what they're going at? I tend to like companies that know who their customers are, right? So we look more to B2B, who their customers are, who they're going to be. They don't have to go create that market. They just have to make sure the team is right, and their development, because we focus a lot on the hardware side, is the technology going to get there? So, we're taking a risk that the technology is going to get developed, so we don't want to take a risk on the market as well as taking a risk on the team. So those are, so that's what we're looking at. And I think Emil touched on this. Not every company is venture backable, right? So people come out there looking for that, not recognized. Not every company is venture backable. And as venture firms, we typically will invest in one for every 100 or so that we see. And it could be even higher ratios sometimes. So just because your company wasn't funded by this venture fund doesn't mean it was the wrong thing. But there's a lot that we see. There's a lot out there. So people have to understand that. So the more they can make their company, attractive, right? Again, with the team, if they've got revenues, obviously a great thing. Again, with us at the early stages, it's not, as Sarah was saying, you typically aren't seeing companies that are revenue generating, but it is a process. We do evaluation of founders. We have technical teams. We have relationships with certain universities, depending on the level of technical diligence that's needed. So there's a lot of steps it goes through before we say, okay, we're considering use a company. So founders have to recognize that there is a process that's going to be available. And the worst thing is sending a cold email that's just, it's a form letter, right? Even you haven't even taken any time to really understand the venture firm, like you're shot, right? Before you even begin. So that is the worst way to approach any of us. Mm-hmm.
Got it. Peter is saying thank you. You're welcome, Peter. So no, but that's a very good point, Brian, because I imagine, all three of you get slammed with proposals, business ideas, and if they didn't even spend the time to kind of, for example, do some basic research and look you up on LinkedIn and know that no, Brian does not do fintech, or Sarah does not do Web3. So might not be very the best use of your time. For our audience's benefit, can you maybe share let's see, the last deal that you the last company that you invested in? So no names, that if you want to kind of keep that out, that's perfectly okay, but maybe a little bit about, just want to understand how this investment climate has been like. And so again, we'll stay in the same order, Brian, then going to Sarah, and then Emil. Maybe the sector it was in, or the subsector of that area with your investment thesis. Kind of what was the amount you did? Anything that's changed now going into this economic climate that you looked at, which maybe you didn't look at a little bit before? Would kind of love to learn more in a more tactical way. Kind of how you went about the investment process or the due diligence. If you want to share any broad geographies, broad sectors, would love to hear that. But again, just if you can take one specific deal that you worked on and kind of walk us through your thought process, how they approached you, you approached them, how was the sourcing done, how was the diligence done, how long it lasted. I think that would greatly benefit our audience. Brian?
Sure. So the last deal we did is in rooftop wind. And so it's a rooftop wind company. So the way we went around the process, so it's myself and another general partner that are the two main partners in the fund. She had been working with this company for 6 months prior. So they had engaged, they were connected through similar networks in, she's located in Birmingham. And so got to know the founders, right? And got to know what they were building, saw what the team was like, and saw how the team evolved from 1 to 2 to 3 people, right, over the initial stages. Because they have a hardware product, we like to see that they had IP, so intellectual property, so they had patents on their stuff, and they had employed various other technical institutions to do wind tunnel tests, to test their technology. They had been accepted into a major accelerator that usually doesn't accept early stage companies. So all of these things sort of led us to prove out what they're doing. Now they've approached us where you're in the energy sector. That's my background, right? So now you've brought me a business that I understand, that I know. I've been in this sector for, as I said, over 30 years. So I can assess where it's going, taking a look at, so we're seeing, hey, there's an opportunity here where they can reduce the cost of wind. They can introduce things that they were looking to right now. It hasn't been fully proven yet, but they're looking to bring the cost down by half in terms of the money to the cost to generate wind.
Patents, any kind of intellectual property or provisional stuff maybe, or not really?
Well, they've developed, because it's rooftop, they've actually taken a way to take advantage of wind as it speeds up going over a building. And so what they've patented is a special wing or foil that sits at the edge of the roof, so it can bring the wind right over the top, versus to have to put a large turbine at the top of the building. So again, for where we like to invest, I'd like to see hardware, right? It's one of the areas. Not only we will look at software companies as well, but understanding the hardware, and so we've done that. And then we had others in our team where I would take it to them and say, what's your assessment of this? What's your technical assessment of what they're putting forward? Does it make sense? Do their numbers make sense? And then what's their impact? We were looking at, from them coming together, what's the gigatons of CO2 that they're offsetting, or not gigatons, millions of megatons they're going to offset over a 30-year lifespan. So we look at the impact. The team right now is 3 women, 2 men. That was a key factor for us. The founder is from the LGBTQ+2 community, so was another factor as well. So we're looking at multiple areas of where we could impact. Founder was a mechanical engineer like myself, so that I could relate. So there was quite a number of things, and it was over, I would say, a 4-month time frame where we were going through, first with my partner, again, to know them over the time before that, and then diligence was probably more intense over a 2-month time period. And we've also employed another third party to help with some of the valuations and looking at comparable valuations from where we think it should be, where the founder thinks it should be, and what's the market doing right now. So it was quite a process we went through. And then after that, we decided to invest $100,000 into this particular startup. So that sort of gives you what we went through in the process and how we came to that decision.
Got it. If I can maybe ask 1 or 2 questions there. So I guess that 100,000 was just a direct check that you wrote, right? What would you say your expenses would be for, the third-party valuation or background checks? Or I'm just kind of, just for our audience's benefit, what are some of the, and again, Sarah, and if you can also, cover this area when you talk about it. What about the out-of-pocket expenses that, what are some of the, there's your time, obviously.
Not counting our time, based on the relationships we've had, we've probably spent in the 5 to 10K range, right?
And is that usual? Like typically 5 to 10% of the investment is on this kind of, or is it more of a flat fee, 5 to 10, regardless of what kind of a check you write? That's how much you have to spend doing background checks and doing,
It varies, right? It depends on the type of investment in terms of this is very hardware, so more hardware intense. So that is taking more technical diligence, right? The founder diligence is more our time. Understanding the market, probably a little bit easier because of my background here versus if I didn't understand the market, we would have spent more. Yeah, I can't say there's a hard, fast number, but that's, there is time, after we get past the initial stages. And that's why, there needs to be initial stage before we're willing to commit money to going further and doing that investigation, right? And that 5 to 10 also includes some of the legal review of it as well on the term sheet.
And it goes back to Emil's earlier point where warm referrals go a long way, because I mean, you may like lower your guard a little bit, right? Okay, the fact came from a trusted source, not 100% of course, but it just helps getting over that hump versus any kind of semi-cold outreach, or your guard is way up, and obviously then you would spend a lot more time, obviously a lot more money on that background check, because again, it's someone coming in pretty cold. So again, that's thanks for sharing that, Brian. Sarah?
Yeah, so I just want to preface by saying the last couple of deals that Swan did were in KiwiTech's. So I can't really speak to those in specifics, but hopefully I can still answer sort of the spirit of the question, which is what have I seen change in terms of the process? And I think a lot of the changes that I'm highlighting are reflective of sort of a more risk-averse macroeconomic environment. You're seeing that also at venture firms, not just in angel networks, where LPs are just more risk-averse. There are other sort of competitive, attractive alternatives. You can park your money in a 5% high yield savings account. So, we've been sort of bracing ourselves for a recession. We're seeing that across all different investors. So some of the differences I've seen is historically Swan really prides themselves on sort of being willing to lead a round, and also for the rounds that they do lead, making a commitment to try and, through their networks, complete that round entirely. Compare that to what we're seeing right now. I'm on a deal where we really want to get sort of a minimum raise commitment before we're willing to commit our angels. So that's obviously like a pretty stark difference to where we were at, 2 years ago. And then Brian was kind of touching on this too. Diligence, I mean, obviously you're always doing a really thorough diligence, but when there is sort of more anxiety, it shows up in diligence. So diligence is just taking a lot longer. There's a lot more back and forth. We're also seeing that the angels that are most interested are really angels who are experts in the sector that the startup operates in. So I think 2 years ago, when people had sort of an abundance of capital, they were willing to sort of play a bit outside of their sandbox, and we're seeing sort of a reversion to staying within what you're most familiar with.
Wonderful. Emil?
All right. So I would mention Algorand, which is a decentralized protocol that we've invested in. The deal came to us through sort of various sources, including venture capital, and also we being close to MIT. The founding team, Silvio Micali, who is the inventor and actually the top cryptographer, or one of the top cryptographers in the world, is an MIT professor. So there's a MIT/VC connection. Long story short, we got introduction, and we invested, co-invested alongside Union Square Ventures, Pillar VC, and a bunch of other venture capitalists. So obviously the team was extremely strong, both technically as well as business-wise, because the CEO who co-founded the company with Silvio, Steve Kokinos, previously was the CEO of a company called Fuse, a wireless company, quite successful one, and he's a serial entrepreneur. So when we looked at the potential of the technology, and basically it's several orders of magnitude faster than previous technologies such as Bitcoin or Ethereum or most other protocols, we saw numerous applications in financial services, in logistic, transportation, supply chain, and a bunch of other verticals. So to us, we basically strong team, disruptive technology with multiple applications, very large market. So it ticked all the boxes for us, and that was sort of the reason that we invested in the company. It's currently valued at $1.2 billion. As far as due diligence, and that's one other thing why referrals are also beneficial is we worked with other venture capital and we shared each other's diligence to reduce costs, and that actually could go a long way. And I don't think we spend 5 to 10, but maybe a couple of $1,000 on that. But it can help you due diligence faster and lower your costs because you may rely here or there on other diligence. Of course, you need to continue asking the questions and not just rely on reports, but dig yourself as well. But it can certainly help. Anything else that you want me to mention in this deal?
No, it's good. Yeah. Perfect. We'll launch into Q&A now because getting a lot of really good questions, and I want to get to them and really, how should I say, very candid questions. So I would really hope for equally as candid responses from all of you. So the question is, which got emailed, was we keep getting told that the only way to get in front of a VC is to know somebody. But what if you don't know anybody? How do I get in front of investors, such as the ones on the panel today, or other investors in general? And I guess it's a two-part question. The background of the question is the company is building a next generation tech. It's in a space all by itself. This has been confirmed by researchers, other state and local agencies, have been applying for venture funding for a while, never hear back. And it's in quotes because I don't know somebody. The application, I guess it's more of a three-part question. Application requires me to divulge a lot of work about our processes, and I hope none of three of you take it personally. I don't think it's I think it's a general question people have about the venture space, and I have heard this before, to be honest, right? The application requires me to divulge a lot of information about our product and our platform, and I am worried that the secret goal of investors may be to hear the information and then steal it. So am I being naive or just paranoid? So again, I listen, I really appreciate the honesty. I would have rather startups and people ask it than not ask it, right? So again, just really appreciate the questioner kind of putting themselves out there and just, but hey, it's good, put you guys on the spot. I can stick with the same order, starting with Emil, Sarah, and then Brian. To summarize, I don't know anybody. How do I get in front of investors? To, hey, investors, are you going to steal my idea? So
okay, let me address the I don't know anybody. You need to go out and meet people. There's plenty of, I'm in Houston. There's plenty of events, and I attend several events per week and connected with a bunch of people that, some of them are investors, some of them are entrepreneurs. There's always in-person connection can go a long way, and start doing it now. Just shooting emails is not going to work because there's no relationship behind it. So that's one. Of course, asking people around within your circle to introduce you to other VCs, entrepreneurs. Entrepreneurs tend to sort of stick together because they're in pain together. So it's sort of not just almost like an AA club where they help each other morally to go through the difficulties. Why I'm saying is because they'll be more helpful they will be empathetic to your pain and help you with your network and introductions.
Second order,
So
second order network, third order network.
Exactly.
Somebody you know directly,
but go out yourself as well and meet people. You have to be. There's no other way of doing that. So as far as divulging information, so I have experienced companies pushing back on. Some of them ask, "Do you sign NDA?" We don't. Well, I never signed an NDA, simply because we're seeing hundreds of companies a month, and there's just, and we're not in a position to, just sign an NDA and not being able to ask, questions of other companies. We're not divulging information. When we do, for example, code review, there are certain parts that founders would push back and say, "I don't want to reveal that code." We will ask to sort of spot check the code without sort of looking into the sort of the part that founder wants to keep sort of secret. So there are ways to avoid that kind of situation by spot checking the code or doing those sort of things. And finally, I would say it's very hard for VCs to just steal an idea, because they're going to have to create a team. They're going to have to go after it's just like a lot of effort to steal an idea, to do that. So the bar to steal it is too high, because they actually have to build a company.
Actually execute, right?
Yeah, exactly.
Yeah, good point.
Hopefully that answers the question.
I think it does. It does. Thank you.
Yeah, so I think everything Emil said is definitely spot on. If you remember what he was saying earlier, your warmest, best intro is from a portfolio company, and founders do tend to stick together. So, once you've sort of identified your target list of VCs, like I was talking about earlier, go through the portfolio, reach out to those founders. You'll also learn a lot about the VCs and whether or not you even want to be introed to them. But that is sort of one of the best ways to get a warm intro. As Emil said, events. I source a lot through demo days. And that's sort of just often I'm seeing founders for the first time. And then, if you're really stuck, consider an accelerator. An accelerator with a good reputation is going to get you a lot of visibility and credibility. In terms of will VCs steal my idea? I mean, let me preface that by saying we're obviously sitting on the opposite side of the table. But, as we said, the early indicators of a successful startup are a combination of things, your secret sauce, right? Your team, your product, and your strategy. So, it's not just the idea, it's actually like what gives you the competitive edge. So just sort of be confident that you are the right person to be executing the idea, and a random VC is not going to be able to just take it and do the same thing that you could do with it.
Thanks, Sarah. Right.
Yeah, I mean, echoing both what Sarah and Emil said, to me, I look a lot for companies going through accelerators. So if you haven't got yourself into a reputable accelerator, I mean, that's a missing. Whether there's some that you have to apply to get in, there's paid accelerators. So there's different ways to get in there and meet people. In business, you have to be a technical person and a business person. If you're there's some founders that are purely technical, spend their time. Engineers are some of the worst, and being an engineer, I can speak to that. Spending the time perfecting it, and you're not out there doing the business. So if you're not out there meeting people and doing the business, and you can't meet VCs, I don't have confidence you can meet customers. Right. So to me, they go hand in hand. If you can go out there and meet VCs and get warm intros and do those things, then you're probably going to have the same ability to meet customers and get customers and sell your product. So that would be one thing I said. Echoing on stealing your idea, I have so many ideas sitting in my head. I wish I had enough people to go put out there and make it happen. I work with some of the universities where researchers come up with great things, and it's like, okay, I don't have the time to go build a team to put this together. So the practical side of stealing someone's idea is very difficult. And as Sarah said, it's a combination of the right team, the right idea, and understanding the right market and being the right timing for that market. So, that's lore. I mean, I've heard of situations of, another founder taking somebody's idea because they divulged it to somebody else. But hearing a VC doing that, I've never heard of it. Not saying it's probably never happened, but if it did, that would kill the reputation of that VC too, because it would get out there. So there's more than one reason why we wouldn't do that. So I would not be worried about that. I would be spending more time convincing them. People are worried too much about the product. Convince me that you got the right team, and convince me there's the right market, right? The product will speak for itself if those two are there.
Wonderful. And I'll add my 2 cents because again, I think it's a very important question, and it's a valid question. So some kind of low-hanging fruits that I'll share is a lot of the people on the panel today, other investors, are usually also thought leaders. They publish articles, they write, and sometimes they do it on LinkedIn, sometimes they do it on other medium. That's a really great way to get their attention is, if you have something interesting to say specifically in your space, and I assume a founder in this space knows a lot about kind of what they're doing because they're obviously building a platform and a unique innovation in that space. Comment on the idea, share your thoughts, right? Disagree with them, right? That, hey, Mr. or Mrs. Investor, you said this, I don't agree, whether it's technical, size of the market, because this is what I've seen, obviously back it up with fact. They'll definitely get their attention, right? I mean, if it's like logical, if it's well thought out, well reasoned, well articulated, I think they'll, even in an online format, a lot of companies, are still doing a hybrid format. I mean, they're still sort of, I guess, recovering from the pandemic, and so it's still a lot of virtual events happening, like the one today. Whether it's the physical events that Emil mentioned, or even virtual events, I think that's another good way. Is just again, interact with them virtually, publish your own articles. Again, that's bound to get people's interest. That's and I think pretty much between Emil, Sarah, and Brian, I think it was all covered. Have somebody else make the introductions, to rely on the second and third degree of your network, not just necessarily the first degree. Go out, kind of put yourself out there. And I love what Brian said. You're almost auditioning, right? If you're not able to get to an investor and sell the idea, how will you get to a customer and sell the idea, right? No matter how amazing the idea is. So I think that's a really good point that Brian mentioned, that any investor will look for that, right? If you're able to hustle and get through to me, you will get through to that C level at the Fortune 100, because again, you have the skills, you have what it takes, the tenacity, and again, the hustle. So again, all fantastic points. Let's see now, a lot of other good questions coming. Thanks, Jim, for your comment on the response to the question. Jacinto is asking, how can a VC detect a good idea from a good business pre-revenue? Good point, obviously, because I mean, if there's revenue, it's easy to run the evaluations, as Sarah mentioned, whether it's DCF models, other ways. Again, Brian, let me stick with you, and then again, we'll kind of go in a clockwise fashion with Sarah and then Emil. So no revenue, super early stage, maybe there's not even a platform. How do you detect a good idea?
I mean, the part of the answer, that's the risk we take as a VC, right? We're taking a risk that it's good. And going back to what I said before, we're relying on that founder to sell us on it. For me, it's convince me first that the market for your problem is big enough, that there's a really good market. Your solution, as Emil said, it needs to probably be disrupting what's there, but you need to show me what that market is, where you're going to be playing, what's the space. That's the first thing I'm looking at, and why is now the right time for this to come in, right? I've had businesses of my own where the timing was right, but couldn't get through the regulatory hurdles, right? So make sure that you've answered those questions of why and how it be. And then what's the right team? Is it just, what's the team that you're putting together? Going back to some of the previous question, if you're the engineer type or the one that's developing and you're not the one to get in front of people, you need a co-founder now that's going to be the one to do that. So convince me you have the right mix of a team or a way to get to the right team. And we're looking at all that. And then at the end of the day, we're taking a risk. Being transparent. For a lot of funds, you're looking at a small percentage of the portfolio is what's going to make up for the rest of the fund that's either going to fail or just do single-digit returns, right? So that's the game we're in, right? Is trying to detect that, look at that, And that's why you're going to bring us something that's inner sector. You're going to bring Sarah something that's in health tech that she can evaluate and use her years of experience to look at it. You're not going to bring her or myself something in fintech because I'm not going to be able to look at it. So I'm going to rely on my background and expertise and my networks to help me look at that. So those are all the things that we look at for finding what's a good business idea, even before it's got revenue.
Awesome. Sarah, before I go on to you, just a quick reminder, we have 3 minutes left. And so one request we're getting from our audience is if you can share your contact information, whatever you feel comfortable, maybe it's an email address or your LinkedIn profile, preferably both, will be very helpful. So, Sarah, you have a minute for you and then a minute for Emil. So please go ahead.
Okay. Please feel free to cut me off too, because I don't want to monopolize. But Brian really hit on what I was going to talk about with Team and TAM, specifically that domain expertise is not necessarily like, let's say I have a company that is trying to treat kidney disease and my founder is an MD in kidney disease. You also want domain expertise across all the different things that you will need to execute as a startup, getting from pre-seed to exit. Brian said that really eloquently. The one thing I would add with TAM, because I know this is really sort of common in the VC world, but I'm not sure how common the understanding is among founders. Because of the power law, which Brian was talking about, typically 80% of venture capital bets fail. That means that we're relying on 20% of our bets to return our fund. And so each time an investor invests in a company, they're investing with the expectation that that single company can return the entire value of their fund. So when you are identifying what your TAM, your total addressable market, and your SAM, your serviceable addressable market are, you definitely want to make sure that that math checks out because we'll be looking for that.
Got it. Save the best for last, Emil. Oh, you're on mute.
I was on mute. Sorry about that. Yeah. So basically, I'll echo quickly. Obviously, direction of the market, the size of the market, we've covered that. Compelling value proposition. If you're in B2B, are you saving significant amount of time, money? Are you opening up a new market, and so on and so forth? Are you improving customer sort of satisfaction and the score and all of that? So compelling value proposition is another one. Other way that I would evaluate whether it's the company has a potential pre-revenue is the pipeline of design partners or pilot customers who are willing to try a product. And then, of course, the question I will ask, what's the feedback? And that's also very beneficial for entrepreneur. That's what they need to do to get the market feedback and see whether it's a good idea. And then what would be the plan to convert the pilot customers into paying customers? So that would be additional sort of ways to tell whether there is the idea has legs.
Awesome. Well, we're up on time. So apologies for some of the other questions that we could not get to. I think we missed one from Ahmed. And we missed for some of the other ones that came on QA. But again, folks, you have the email address. Thanks so much, Emil, Brian, Sarah, for putting in your contact information as well as LinkedIn accounts. Really appreciate all three of you making the time today and other guests who were able to attend. Hoping to do a lot more of these. But again, as we come to the end of the year, want to wish everybody a Happy New Year, Merry Christmas in advance. Again, it's 3 weeks away, but I feel like it's going to happen, before we know it. So again, thanks everyone for taking the time today, all the guests who attended, other fellow investors, and then obviously our esteemed panelists, Emil, Sarah, Brian. Thank you so much for taking the time today.
Thank you.
Thank you.
Bye-bye.
Thanks for having us. And thanks to my panelists for being part of this with me.
Right.
Take care. Bye.